Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at T3 Defense.
If you find our talks useful, please consider subscribe, like, and comment underneath. And before we jump into what is honestly a crazy chart today, I need to quickly mention StockOracle.
Right, which is an AI-aided stock research platform we use.
Exactly. We have a special 14-day trial link below in the description for you. Now, that is an affiliate link, so the channel may earn a commission at no extra cost to you.
And we just have to remind you, StockOracle is not financial advice. It's not a trading signal service, and it doesn't give you real-time market data.
Yeah, plus, AI insights and valuation estimates, they can be incomplete or just wrong sometimes. Always verify the important facts yourself. Okay, so with that out of the way, I want you to imagine you're watching a heart monitor, right? And the line is just completely flat.
Like legally dead.
Basically, yeah, we are talking about a stock that has lost 99.6% of its value over a single year. T3 Defense, ticker DFNS. It hit absolute rock bottom. The broader market practically left it for dead. And then out of nowhere, you get this violent, massive heartbeat. In one single day, the stock explodes upward by 201%.
Which is, it's the financial equivalent of a jumpstart. The sheer velocity of a move like that, it forces everyone watching to suddenly sit up. You have to ask if the entity you thought was dead is actually springing back to life.
Right. And today, our whole mission is to decode that exact phenomenon. We are looking into the wild, high-stakes world of microcap turnaround plays. We've got financial filings, insider trading data, sentiment reports, all centered on this one specific defense technology firm.
And when you see a chart exhibiting that kind of whiplash, your immediate reaction is usually heavy skepticism.
Oh, 100%. My first thought is this just speculative market noise, like a bunch of day traders and algorithms just having a field day? Or are we looking at the very first signal of a massive, fundamental business turnaround?
Well, so in the microcap defense sector, extreme volatility is kind of heavily baked into the daily trading action anyway. But quite often, that really wild, erratic price movement serves as a smokescreen. It completely masks the true underlying value of a company's physical and intellectual assets.
Which brings us to the wealth building context here. Because to understand that 201% explosion, we have to look under the hood at their actual business metrics.
Like the fundamentals.
Yeah, and the filings present one of the most glaring contradictions you can honestly find in a quarterly report. The top-line revenue growth is staggering. T3 Defense boasts a year-over-year revenue growth of 788.14%.
They are nearly octupling their revenue, which is wild.
Yeah, it's insane. In almost any other context, that kind of parabolic growth means a company is just knocking it out of the park, executing on major contracts, aggressively dominating new market verticals, you name it.
But the paradox emerges the second you look at the bottom line. The profitability metrics are, frankly, abysmal.
Yeah, they really are.
The filings show a net margin of negative 743.14%. Their earnings per share, their EPS, over the trailing 12 months is negative 2.44.
So for every single dollar they actually manage to bring in the door, they are burning a massive amount of capital just to secure it.
Exactly.
Okay, but let's be real for a second. A negative 743% margin is a ticking clock. In most industries, if you are losing that much money for that long, you're handing the keys back to the bank. You're closing your doors. So why hasn't this company gone bankrupt yet?
Well, that comes down to the really grueling mechanics of government contracting. To even get a seat at the table with the Department of Defense, a company isn't just, pitching a fun idea. They're absorbing massive, non-negotiable upfront costs.
What kind of costs are we talking about here?
So before you ever see a dime of government money, you are building highly secure facilities. These are often known as SCIFs, Sensitive Compartmented Information Facilities, just to legally view the classified requirements of a contract.
Wow, just to read the contract.
Just to read it. And then you're pouring millions into localized R&D. You're spending a fortune on bid and proposal teams who have to navigate thousands of pages of red tape and bureaucratic compliance.
Right, because it's the government. Everything is forms and compliance.
Exactly. You have to scale up your specialized manufacturing to meet extreme military-grade specifications. It is a highly regulated industry that legally requires you to bleed cash just to capture market share in the first place.
It's kind of like, it's like building a massive state-of-the-art factory from scratch.
That's a good way to look at it.
You bleed cash for years. You're laying the concrete foundation, you're buying the heavy machinery, you're paying structural engineers. To an outside observer, your balance sheet looks horrific.
Oh, terrible. Just purely red ink.
But the underlying thesis here is that once the conveyor belts finally turn on, or in this case, once those massive defense contracts actually start hitting the books, the operating leverage kicks in.
Right. Because the fixed costs, like the security clearances and those secure facilities, those stay the same. You've already paid for them. But the revenue compounds, absorbing those initial expenses and driving the company rapidly toward break-even.
So that 788% revenue base we're seeing, that is the primary indicator that those conveyor belts are finally moving.
Yes. The contracts are leaving the proposal phase and entering the billing phase. And what's fascinating here is how the broader market has priced this company during that really painful cash-burning setup phase, because the balance sheet presents an extreme, almost historic value proposition.
I saw that in the data, yeah. The total market cap of the company plummeted to just $4.39 million, which gives them a price-to-book ratio of 0.1215.
Let that sink in for a second.
Right. Are they really trading for just 12 cents on the dollar of their actual physical assets?
The math points directly to that conclusion, yeah.
Yeah.
The market is valuing T3 Defense at a tiny fraction of its net asset value. We are talking about a company holding specialized defense equipment, highly protected IP, and active government contracts.
All of which has real tangible value.
Exactly. Theoretically, those underlying assets are worth substantially more than a $4.4 million market cap. So for a value-oriented institutional investor, that massive disconnect offers a significant margin of safety.
And think about how you evaluate companies in your own portfolio for a second. When you're looking at a stock screener, do you only focus on the bottom line? Do you just see the negative EPS, assume the business is dying, and run away?
Most people do.
They do. Or do you take the time to look at the underlying asset value that the broader market might be completely ignoring in its panic? Because that disconnect is the absolute crux of the turnaround thesis we're looking at today.
It really requires looking past the immediate cash burn. But, evaluating assets is only half the battle. If the fundamentals are a waiting game like a race between burning through cash and realizing new revenue, we have to look at the people steering the ship.
To gauge the true risk of insolvency, right?
Right. You look at the insiders, because standard logic dictates that if the ship is actually sinking, the captain and the executive crew are usually the first ones scrambling for the lifeboats.
Dumping their shares before the public finds out.
Exactly. But the insider data here tells a completely different story. Over the last 90 days, during the absolute worst of the price decline, there's been zero insider selling.
Zero. None at all.
None. And if we look at a metric called the Management Sentiment and Positioning Ratio, the MSPR, it's currently sitting at a perfect 100.
Which sounds incredibly impressive, but what does a score of 100 actually measure in the real world? How is that calculated?
So it's a composite score. It evaluates insider behavior, specifically against the stock's historical performance and volatility. A score of 100 doesn't just mean management isn't selling.
Okay, what does it mean then?
It means that despite the stock hitting absolute historical lows, their conviction to hold their positions is in the top percentile of all tracked companies. They aren't liquidating to cover their own personal risk.
So the complete lack of capitulation from the executive suite strongly indicates that management really believes the forthcoming revenue will outpace their current liabilities.
Yeah, their confidence likely stems from the competitive walls they've built around the business. It is incredibly difficult for a new competitor to just show up and steal their government contracts.
Let's talk about those catalysts, because the defense sector provides one of the strongest economic moats in the business world, doesn't it?
Oh, absolutely. It's primarily driven by extremely high regulatory switching costs. Government contracts are notoriously sticky.
Sticky meaning hard to get out of.
Right. Once a company is embedded in the Department of Defense's supply chain and their bespoke technology is integrated into military systems, it is a logistical and security nightmare for the Pentagon to replace them.
So that 788% revenue growth implies that T3 Defense has actually successfully navigated that grueling DoD procurement gauntlet.
Yes. They are now monetizing systems that competitors cannot easily displace without spending years and millions of dollars to get those exact same clearances.
Okay, but I'm sorry, I have to push back here.
Go for it.
You're painting a picture of this impenetrable fortress. You've got billions in defense spending backing it, exploding revenue, zero insider selling. If things are really that bulletproof, why did the broader market leave this stock for dead? Why did it plummet to $3.70 and lose 99% of its value?
It's a fair question.
Right, the market isn't usually that blind.
Well, the market might not be blind, but it is highly emotional and incredibly impatient. To answer that, we have to transition away from the internal business operations and examine the external market psychology, the technicals that drove the stock to the brink.
Okay, let's get into the technicals then.
We are looking at the mechanics of a capitulation bottom.
This is where it gets really interesting, honestly. The technical setup of this stock over the last few days is just wild. Let's walk through the actual timeline for everyone.
Let's do it.
So the stock bled out for months, eventually plummeting to a 52-week low of $3.70. And at that exact point, it was down 99.13% year to date, just total decimation.
And at that specific low, you reach the psychological breaking point for retail investors. The capitulation bottom is the exact moment when the very last exhausted, frustrated sellers finally throw in the towel.
They just can't take it anymore.
Right. They stop caring about the underlying asset value.
Yeah.
They just dump their shares at whatever price they can get just to stop the pain of watching it drop every single day.
But when everyone who wants to sell has finally sold, the selling pressure hits absolute zero.
And that is when the quantitative scanners used by institutional whales start flashing. Because these institutional algorithms aren't looking at emotion, they are designed to hunt for massive structural disconnects in value.
So they see the selling stop and they pounce.
Exactly. When the selling pressure vanishes, they see a company generating massive top-line revenue, sitting at a price-to-book ratio of 0.12. They recognize that the assets alone are worth far more than the market cap, so they trigger automated, highly aggressive buy orders.
And the scale of that buying was phenomenal. The stock gapped up violently overnight. I mean, its previous close was $4.35. The very next day, it opened at $6.96.
Skipped right over the $5 and $6 levels entirely.
Just completely blew past them. And then it kept running, hitting an intraday high of $15.99 before finally settling at $13.10. That is a 201% upward change in a single trading session.
And the volume data proves this wasn't just, a handful of retail traders swapping shares on a message board.
Right. It wasn't a meme stock push.
No. The standard 10-day average volume for DFNS is around 2.9 million shares. But on this massive surge, the volume was running at an astonishing 7.1, 3 times its 3-month average.
That is just an absolute flood of institutional capital entering the stock.
Yeah, that massive volume injection is the mechanical driver of a momentum shift. And the algorithmic news sentiment scoring completely corroborated this sudden flow.
How so?
Well, some basic sentiment algorithms might technically read as neutral because of the historical price drop, right? But the actual real-time news text was flagging DFNS as a top gainer across the board. It was up 22% in Monday's aftermarket session and a massive 64.6% in the pre-market session.
I want to dig into another layer of this violent surge, though, because it might not just be value investors buying the dip. The sentiment data mentions rumors swirling about a massive short squeeze.
Oh, yes, the short squeeze.
And the data points we have make the mechanics of that rumor very, very plausible. The stock has a highly erratic beta of -6.74.
Which is extreme.
Right. So we need to explain what a -6 multiplier actually means in the real world for the person holding the stock.
So beta measures a stock's volatility relative to the overall market, right, which is always set at a baseline of 1.0. A beta of -6.74 is incredibly extreme.
Because it's inverse.
Exactly. It means if the S&P 500 drops 1%, this stock theoretically has the statistical potential to spike nearly 7% in the exact opposite direction. It behaves completely detached from normal market gravity.
So when you combine that kind of erratic, explosive volatility with a massive volume anomaly and a sudden reversal off a 52-week low, you essentially create the perfect mechanical trap for a short squeeze.
You do, because bearish speculators who borrowed shares and sold them, hoping the price would go all the way to zero, are suddenly trapped in a burning building.
Yeah, when the price gaps up from $4 to almost $7 right at the opening bell, their brokerage accounts immediately start flashing red.
And then they face a margin call. The broker looks at the massive losses the short seller is taking and demands they deposit more cash immediately to cover the risk.
And if they can't?
If the short seller can't produce the cash, The broker forcefully liquidates their position. To close a short position, you have to buy the shares back at the open market price.
Which creates a brutal, vicious cycle, because the forced buying from liquidated short sellers drives the price even higher,
Right.
which triggers margin calls for the next level of short sellers who then have to buy, pushing the price higher still. It is a purely mechanical driver that can propel a stock from $4 to $15 in a matter of hours.
Regardless of the company's actual fundamentals.
Exactly.
It is thrilling to watch on a chart, but it introduces a massive amount of artificial inflation to the stock price. The buying isn't necessarily because people believe in the company. They are just buying to survive the margin call.
Which means we need to pause here and issue a major reality check. We have to look at the bear case and the risks. Before anyone gets swept up in the momentum of a 200% surge and assumes the pain is over, we need to balance this narrative.
Definitely. There are glaring structural risks here that could entirely derail this turnaround.
Let's go back to the elephant in the room, the cash burn. If T3 Defense cannot figure out how to convert that massive 788% revenue into actual bottom-line profit soon, they face a very real existential threat.
Insolvency is the primary risk here. The operating leverage we discussed earlier, that whole idea that compounding revenue will eventually absorb the fixed costs, that has to materialize quickly. The market's patience is finite.
And if they run out of cash before they hit profitability, they only have a few really ugly options. Perhaps the most dangerous for current shareholders is a highly dilutive equity raise.
Oh, dilution is a killer.
To keep the lights on, management would be forced to issue millions of brand new shares onto the open market. That influx of new supply instantly devalues the shares you currently hold, which crushes the stock price all over again.
And then the secondary risk is purely technical. We have to address the threat of the dead cat bounce.
Right. We saw the stock hit an intraday high of $15.99, but the day's low was $6.11.
That is a massive intraday spread. It demonstrates extreme, dangerous volatility where early buyers are eagerly dumping their shares onto latecomers.
So if you are looking at a chart, how do you actually distinguish between the two? How do you know if you are looking at a genuine business turnaround driven by long-term institutional accumulation or just a fleeting algorithmic momentum trap that's just going to collapse back to $3 tomorrow?
Well, you look for structural follow-through in the days immediately following the surge. A momentum trap, like a dead cat bounce, is usually a one-day wonder. It's driven entirely by retail emotion and the forced short covering we just talked about. Once those margin calls are satisfied, the buying volume dries up instantly the very next day, and the price bleeds right back down to its previous lows. A genuine turnaround, however, will establish higher lows.
Because the big players aren't leaving.
Exactly. The institutional whales who bought the capitulation bottom because of that 0.12 price-to-book ratio, they aren't going to sell for a quick 20% intraday profit. They are holding for a fundamental repricing of the entire company. You have to watch the price action over the next few weeks to see if that $13 level holds as a new floor of support.
So we're at the final verdict here. What does this all mean? When we weigh the incredible underlying asset value and the exploding top-line revenue against the very real existential threat of cash burn and potential dilution, where does this actually leave us?
Well, looking at the data, it establishes a very specific target horizon. The stock is currently rated with a 7 out of 10 bullish score.
7 out of 10, okay.
But it is explicitly characterized as a high-risk, high-reward turnaround play. You have to remember that. The primary timeline to watch is a 1 to 3 month swing trade leading directly into their next quarterly earnings report.
Because that upcoming earnings report is the ultimate catalyst, management can't hide behind the 788% revenue growth anymore. They have to prove with hard numbers that they are actually shrinking that negative 743% margin.
Right. The broader market is going to demand a concrete timeline for profitability. The earnings report will be the judge and jury.
Are there any macro factors playing into this timeline?
Yes. While we wait for that earnings data, there are a few macro tailwinds that could provide continued momentum. Any new Department of Defense or NATO contract announcements will act as immediate bullish catalysts. It proves to the market that the revenue engine is still acquiring new targets.
Makes sense.
Furthermore, there is the broader macroeconomic picture. There are potential interest rate cuts penciled in for late 2026. Lower interest rates reduce the discount rate applied to microcap growth stocks.
which fundamentally makes DFNS's long-term valuation models look far more attractive to institutional investors who are modeling out their 5-year returns. So it is a massive, delicate balancing act. I mean, they have the defense moat, they have the explosive revenue, they have the incredibly cheap asset valuation, but they absolutely have to stop the bleeding.
They do. And, looking beyond the immediate financial data we discussed today, this situation raises a really profound philosophical question about the very nature of economic moats in the modern defense era.
How so?
Well, we spent a lot of time talking about how impenetrable the DoD procurement process is and how sticky those specialized hardware contracts are.
Yeah, we said it takes years to get the clearances and build the physical factories.
But the reality of modern warfare and global defense is rapidly shifting.
Yeah.
We are moving away from traditional physical hardware and heavily into the realms of artificial intelligence, drone swarms, and cyber warfare.
Oh, that's a great point.
Because ultimately, the risk isn't just a traditional competitor underbidding you on a hardware contract. The risk is the Pentagon deciding that next-generation warfare requires software, not your highly specialized, heavy hardware.
Wow. Yeah.
And if government spending pivots overnight to an entirely new technological domain, does today's heavily regulated impenetrable hardware contract become tomorrow's stranded asset? That is the real existential question you need to ask yourself before assuming any moat is truly permanent.
That is something to truly mull over. The ultimate risk isn't just a competitor stealing your contract. It's the contract itself becoming entirely irrelevant. It just goes to show that in the world of microcap investing, you can never just take the numbers at face value. You always have to ask what those numbers represent in the real changing world.
Absolutely.
Well, we started this looking at a heart monitor that had flatlined. A stock down 99%, completely left for dead before violently jolting back to life. Whether T3 Defense is truly resurrected and ready to sprint, or if this is just the final chaotic twitch before the end, it all comes down to their next earnings report. So keep questioning the headlines, keep digging into the mechanics behind the numbers, and remember to look for the story the market is trying to hide from you.
And if you want to dig deeper into those mechanics, don't forget to check out the StockOracle platform.
Yes, great reminder. We've got that 14-day trial link in the description below. Again, that is an affiliate link, so the channel may earn a commission at no extra cost to you. And please, just a final reminder, subscribe, like, and comment underneath if you enjoyed this breakdown. We will see you on the next one.